Welcome everyone. This is Drashti and I am part of the business partnership team at DAN. Thank you everyone for taking out your time and joining us for today's webinar. We'll wait for 2-3 minutes for everyone to join in. Okay, so let's get started. Welcome to today's webinar by Vidyawala and Mr. Damani. They will be taking us through Nifty's hide and seek at 1800. So just a little housekeeping before we start. If you have any questions during the session, please type them in the question box or I'll bring them up during the end of the session. I'll just give you a little brief about Vidyawala and Mr. Damani. Vidyawala is co-founder of Prime Investor and Investment Research Solutions platform for retail investors. Vidya is a chartered accountant and a postgraduate in economics. She has over 20 years of post qualification experience, of which 18 years were spent analyzing stocks, mutual funds, and other personal finance products. Prior to starting her own firm, Vidya was heading research at fundsindia.com, India's first online mutual funds platform, and was earlier chief research analyst with the Hindu Business Lines Research Bureau. Now, a little about Mr. Damani. Mr. Damani started his capital market career in mid 2000s with Equity Intelligence India and then worked with several capital market intermediaries in various roles over the last 15 years. Most of his career experience has been in equity, research, and PMS. Most recently, he was with Mott, a PMS firm. He is a graduate in mathematics, a postgraduate in finance, and holds a CFP certification. And today they will be taking us through Nifty's hide and seek at 1800. Over to you.
Thank you for the introduction, Drashti. I'm not sure if you heard me the first time. So I'm going to have my colleague Chandra Chudamani, share the screen here, and without much ado, we both are going to take you through the Nifty's hide and seek, as we wish to call it. So 18,000 seems to be a very interesting number for Indians in the Indian market, or 18 seems to be a very interesting number for Indians. There are 18 chapters of the Bhagavad Gita, and for some reason the market also appears to think that 18,000 is something that it can hold on to, and it has held on to it for almost 2 years now, beginning 2001 to 2023. There has been returns here and there, but it seems to have got stuck, at this range. and struggling to meaningfully come out of it, even as some sectors performed and some sectors underperformed. Now, this 18,000 to 18,000 is very important for you as an investor to understand, for the simple reason, when stocks do not seem to deliver, you may still be able to identify pockets of opportunities. And that's what we are going to discuss today. But before that, we're going to try and understand what makes this market get stuck at this kind of levels and what exactly happened over this period. And for that, I'd like my colleague Chandra Chudamani to explain this period.
Yeah.
Over.
Thanks, ma'am. I'm audible now?
Yes, you are audible.
Yeah. So good evening to all who have joined this webinar. So as Vidya ma'am pointed out, like it is for last 1.5 years, Nifty has spent time between 18,000 and 18,000. But then as far as investors are concerned, this period has actually thrown out unexpected surprises in terms of how the different sectors have moved. So what I'm going to do here is to take through what actually played out, how it played out, and why it has played out. Okay, so let us first try to understand the base from which this market rally has started. So if we look at the pre-COVID index level, the pre-COVID Nifty level, that was 12,000 or precisely 12,400. So from there, in the next 1.5 years, Nifty has actually rallied 50%. So after that 50% rally, it has paused and it has now spent nearly 1.5 years or 18 months in that zone actually. So every time it gets down, it rebounds back to that level. So let us try to understand how different sectors have played out during this journey. So first, let us take the rally from 12,000 to 18,000, and the sectors that were in limelight during the rally were IT and pharmaceuticals, and pharmaceuticals, as we know, for obvious reasons after COVID. So, and there was also other sectors like metals and all, but the most important sector and the index heavyweight in limelight was the IT sector. So it is also very interesting about that sector because if you look at 3 years prior to COVID, the sector was actually struggling to deliver growth. So the companies were actually paying out dividends, they were doing buybacks and all, and even the sector PE was actually lower than the index at that point of time. So it is from there actually it took off in a big way, such that actually the stocks actually doubled and trebled in a short span of time. So it was actually the quickest rally for the sector in a while, or even to say in the last decade. And even what we saw is that the PE re-rating happened in such a way that the PE almost doubled for even the larger companies. So larger companies in the sense they are 5 lakh crores above or 10 lakh crore above companies actually. So this is how it played out for the sector, and the sector literally stole the show in that rally actually. Then it was followed by pharma and all. And later on, what we saw in the sector was the new age tech IPOs. So this was a time when the US tech index was also doing very well, and the narrative surrounding it, whether the IT, our IT stocks or Nasdaq, was the digital transformation journey. So this is what's driving all the rally, and that was also the appropriate time for all these new age companies to come up with IPO. And with the Paytm IPO, it actually, the market actually peaked out, but there was still no trigger for fall, and the trigger for the fall actually came in the form of Russia-Ukraine crisis few months later, that is in the beginning of 2022, and the market took a deep dive. But interestingly, the fall in the market was not led by the sectors that were going up. That means IT and pharma or whatever it is, but it was actually led by the banking sector. So the banking sector actually fell in such a way that the bank index, or what we call the bank Nifty, actually fell to what it was at the before COVID, like what the bank Nifty level was at the time of when Nifty was at 12,000. To that extent, it fell. And it caught investors in a dilemma because the sector was doing well. It was out of NPA crisis. The capital adequacy is good. Earnings are coming. So why it fell? So it was a question mark that was surrounding for a long time. But then in the next eight months, so between February 22 and December 2022, in the next 8 months, what happened was a dramatic turnaround in this sector. So the sector itself rallied 30-35%. And from 52 low, it actually took 52 high. Not only it took 52 high, it single-handedly led the Nifty back to 18,000. So whatever happened during the 2022, it was this bank Nifty alone, this banking index or banking sector alone single-handedly lifted Nifty to 18,000. And by this time, we have actually seen other sectors underperforming, whether it is IT sector or pharmaceutical sector or new age technology IPOs or whatever, they have just started underperforming. So this is how it has played out. And to add to that, we have also seen other sectors like capital goods and autos that were turning around, and capital goods also caught investors by surprise actually. How the turnaround happened for IT sector. In the case of capital goods also, investors were caught by surprise. And then again, in the beginning of 2023, what we saw is another major correction. So whether it was triggered by the Adani saga or whatever it is, a correction followed, and then it ended with the Silicon Valley banking crisis. So by this time, what happened is that the sector that was in the driver's seat, IT earlier, that is actually completely given up. Completely given up in the sense that whatever PE re-rating that has happened, that has been completely given up. That means whatever growth expectation that was built on the sector, that has been completely given up. Likewise, the same thing happened for pharma sector, where whatever excess that was built up during COVID, because whether market realized it or not, there were some additional revenues and profits and margin gains that were coming for these companies. So all these things started reversing. So these sectors literally came to 52 low, and along with that, all these new age tech IPOs and all those things as the valuation story fizzled out. So this is how it panned out. And again, now again index is back at 18,000 after this Adani saga, SVB crisis and all those things. And this time when we see again, it is being supported by banking sector. It is being supported, but what we see in that sector also is that again, they are just hesitant to make new highs, but yes, that is still in the driver's seat. So this is actually what has played out in the last 18 months. There has been a totally dramatic shift in the way every sector has gone up and come down, because the magnitude is very high. So the kind of re-rating that happened in IT sector is so high, then it gave up entire thing. Likewise, what we saw in banking sector was a significant rally actually. So this is how it has played out actually over the last 18 months.
Right,
back to Vidya.
Right, Mani. So, I mean, that's a lot of data and statistics that Mani has given us across these periods. The important takeaway here, just to simply oversimplify it, if I may say, that COVID has not just wreaked havoc in our bodies, but it has also, led a lot of deceptive sector trends only to deceive us later. I mean, from what Mani has said, just to summarize, the IT sector, everybody thought going digital would be the future, and it is, but that led to significant PE rating that could not sustain. And if you see pharma, if you see chemicals, if you see, diagnostics, all of these rallied during COVID, and then post, the opening up, margins and revenue collapsed. And then there was a lot of importance given to quality. Quality was a big deal. Then, as you would know, post-COVID, quality has taken a back seat. When I say quality, it doesn't mean companies that are not qualitatively good don't survive, but those that were commanding very high valuations in the name of quality couldn't sustain. So broadly, those are the deceptive things that COVID brought about. And for many of you who tried to ride these at a later part of a rally, you would have gotten significantly hurt. Or if you had been a little lucky, you would have stayed flat. And that is where our 18,000 to 18,000 journey also comes into play. So I would, on this count, it will help if we just give you a few examples with companies to show you the kind of, stocks where you could have gotten stuck even if they were high quality stocks. Mani, can you take us through that?
Yeah, sure. So this is actually the PE ratio chart, 10-year PE ratio chart of Infosys. And this is also the representative of the large cap IT sector. Also, it has similarly played out for all the large cap IT stocks. So what you can see is that there was the PE re-rating that happened was, it was from between 17 to 21 times earnings before COVID. And then it really took off to 35 times above. So this has happened in the entire IT sector for the large cap IT sector as a whole. What happened after that is that after the Nasdaq correction or the US interest rate issue and all those things, the sector has given up one step. So the PE has contracted below 30 times, or it has retraced to 25 times and all. And after the recent Silicon Valley banking crisis, actually it has retraced entirely to pre-COVID levels for Infosys. So what it means is that this is not for Infosys alone, but for the entire sector, and especially for the BFSI, banking, financial service, and insurance company heavy top IT players after the Silicon Valley banking crisis. So what this means is that if you are someone who has invested in Infosys prior to COVID, you are still sitting at handsome returns, because between 2020 and 2023, the profit of Infosys has grown by 50%. So that gain is still there, and the stock price is also 40 to 50% up from pre-COVID levels. So, but what if you entered the stock during this rally or sometime halfway in between? Then there is where this deceptive trend has played out actually. Likewise, let me also get into this pharma space. That is where it has again played out. So this is again the earnings chart of Divi's Lab, the quarterly earnings numbers for Divi's Lab. And this is also representative of what happened to the broader pharmaceutical space. So for Divi's Lab, we have actually seen in Q3, Q4, in FY22 as a whole, you can see some small spikes and suddenly big spikes in 2 quarters. So this was all led by COVID drug actually. And even during this time, market was actually trying to give higher multiple for the stock, believing that this could sustain and all, but later everything reversed, and including the margins. So not only the sales revert, including the margins, and the stock took a deep knock. And this is not about Divi's, but it is representative of whatever happened in the sector as a whole. If you take Pfizer or Ipca or Loras or whatever it is, this is broadly, whether it is the sales contraction or margin contraction or both, this is what's actually happening for the entire sector, and that is why it resulted in this deep correction of 40, 50, 60% for the stocks. And next, let me also take through this quality thing. This is also very important, and this is the chart of Unilever. So here you can see that the price of Unilever was at 2000, nearly 2,400 in April 2020, and today it is almost at same price. So what played during COVID is that all investors were worried, because suddenly an unexpected event came and there was no clue. Suddenly everything was shut. So nobody was having any clue of what to do. But so what could have happened is that investors could have switched to defensive or quality basket like Unilever. Quality in the sense, I mean similar stocks, whether it is in FMCG or discretionary or financials or whatever is believed to be high quality companies prior to COVID. So if you had switched to all these stocks at that point of time, so what would have happened? So we had just mentioned about a Nifty journey from 12,000 to 18,000. That is a 50% return after COVID. So what if you had switched to all these stocks? You would have substantially or significantly underperformed even the index returns, and the most disastrous case would be that if you had booked losses and shifted to these stocks. Imagine if you had Indian hotels before COVID and you had booked losses and shift to any of these quality basket. So it would not have even helped you to recoup the losses. So just to mention that it is not that anybody would have done this or this would have even happened for someone. But the thing is that trends that played out in the market have been highly deceptive, and this is what I just wanted to bring it here. So this is how whether it is in terms of the PE re-rating, or whether in terms of the PE re-rating and then de-rating, or whether in terms of earnings, sudden spike in earnings or the contraction, or high valuation, then high valuations, then contracting, or PE ratios contracting over a period of time. So these are some of the deceptive trends or unexpected trends that has actually played out in the market. And to summarize on why it has played out, actually, so it has played out, then it is actually to do with how market functions. So it is how market values companies and how market looks at companies. So here what we have done in whatever cases or whatever examples we have done, we have discussed what market has done is that it has given peak valuations or rich valuations at a time earnings were actually doing well. whether it is in the case of IT sector or whether it is in the case of pharmaceutical sector, or even if you take the quality basket as a whole, where in the last decade they had less of challenges on margins or commodity prices or raw material prices. Market was extrapolating all these trends actually to give them rich valuations when their earnings were also at their peak. So even the whatever, whether it is a digital transformation or whether it is the pharmaceutical story, market was actually extrapolating that trend a bit and then giving them rich valuations, which didn't go well later on. So when earnings didn't keep pace, or when the market realized that this was some excess that was built up and this is not going to play out, then actually the stocks faced up with a hard knock. So this is how it has played out. So starting from the sector volatility to how these corrections have happened.
Right. Right, Mani. So Mani basically, has tried to tell us, that the markets sometime, given the circumstances, tends to assume, that current situation can continue forever. And that didn't basically happen with many of the sectors that we spoke about. And that's where we went wrong. In Q&A, I can see a gentleman tell us, we know what happened, in the past, tell us which sectors will do well. Of course, we will, but the answer is not that simple, sir, for the simple reason. Looking at the past is very important to understand how we can avoid the temptation to get into sectors or stocks at the wrong time, especially when markets itself seem to give you a hint that they are doing well and that there are prospects. So on that count, if you can go to the next slide, Mani, what we are trying to say in the next step is, even if you found the right sector, assuming, you got the sector wrong, you didn't do well, fine. But even if you did find the right sector, there has been and there continues to be significant divergence in performance within sectors. I mean, within stocks within a sector. And that can also screw, our wealth building, the way you pick stocks, I mean, your own investment journey. And in this session, our endeavor is to basically try and let you know those kind of warning signals and alerts and how to stay away from them and how to identify. So that's the idea behind the session. So different sectors not performing, and now divergence even within the sector. We have more examples so that we learn from these examples. Mani, can you just go ahead with those examples?
Yeah, so this is what happened with the consumer sector. So after lockdowns and all these stocks, whether it is discretionary consumption, unlocked themes, all these stocks rallied, and Bata also rallied to 52 guys. But later only market realized that Bata was not able to capture the growth. But at the same time, what happened is that the newly listed metro brands was clocking significant growth. So from pre-COVID to post-COVID, like FY23, so it was 10% for Bata, 50 to 60% for metro, and even so metro, I think like it is the Crocs, Mochi, and all these a bit of higher end brands they are selling. So what eventually happened is that metro became the leading company in the sector with the highest market cap. So and similar kind of trend played with Jubilant versus Westlife. Market extrapolated Jubilant's in-home consumption trend during COVID as sustaining, but then something else happened after the unlock. Westlife significantly outperformed actually Jubilant, because it also survived the COVID with in-home deliveries and all those things. And then when the external demand came up, they were quite geared up for that. So likewise, we also saw that divergent performance in some expensive stocks in the same sector, almost literally. So it may look like these are not comparable, but literally they are actually into the same core product, actually, with whether it is the differential gears or assemblies or all these things. And then it is the valuation that played the spoil sport. So the promise that didn't deliver for one, for other the valuation was even not that expensive to get into. So that divergent performance happened again here. So what the key takeaway here is that I will also touch upon that question. So it is very important to get into the right sector, because right sector in the sense, whatever sector that offers decent earnings growth plus return on equity, that is where investors can make money. And the most important thing here is the right entry valuation. So whatever we have discussed above in case of the IT sector example or pharmaceutical example or all these things, it is where investors got into either halfway or towards the end of that rally, or maybe the last 10% or 20% of the rally. So what can happen at that point of time is that when something goes wrong, and when something goes wrong and the sector corrects, the chances of making losses are higher. So this makes us important to look at the historical valuation. So we have actually written an article on this, and then we have given a 5-point checklist as to what all things you can look at to avoid these kind of traps. That doesn't mean you can use that checklist and avoid all the definite traps, but it clearly gives an indication as to what kind of things, what financial information that you have to check to avoid these kind of traps. That is what we have written in that article. And some of these things, like the deviation in the revenue from the normal. So if some company is reporting abnormal deviation in revenue, and it is not caused by volume growth, or if it is caused by abnormal events like a sale of some new product, or abnormal price inflation in one product, all these things are not sustainable. So whenever there is a deviation in financial performance, it makes sense to inquire that. And after that deviation, it doesn't make sense to enter that company at significantly higher valuation. So this is the most important catch. After you observe a deviation, it doesn't make sense to enter at higher valuation without investigating. So that is the most important thing. And then bottom-up stock picking, that is also the third important thing. That is important from the point of view of what we have explained in the case of sector divergence within the sector. So within the sector, stocks can behave differently. And so it is extremely important to screen through stocks as well, whether something is going in the opposite direction also. Right. So these are three important points. And I also know, while telling this, I also know that there is no one can get 5 out of 5 sector, 5 of the sectors right, or 10 out of 10 of the stocks right. The idea is to apply all those checks and to ensure that you reduce mistakes. So that is the most important thing. Whatever efforts we are putting in it is to reduce the mistakes, and then rest market will take care of. That is the idea. Back to you, Vidya.
Right. So Mani basically, kind of gave us takeaways. But if that sounds a little theoretical to you, I think it's time that we shared our own experience on how we picked about the right sector, the right entry valuations, and we're also very conscious of the nature of stocks that we put into such portfolios. So as you may be aware, at Dun, we do have our small cases, and 2 of our small cases have been really well timed in the market and have delivered rich returns. We would like to share our experience on how we went about choosing this sector. Mani, can you explain a little bit on our small cases on how we achieved the timing?
Yeah, sure. So let me take our one small case, Auto plus plus here. So this small case actually, it is about the revival and transformation in the auto sector. So before that, let me talk about how we got into it. So that will give more insights on how to get into right sector. So how we got into it. So as usual, we were screening for stocks. And then what struck us is that the auto sector was going through a downturn from FY19. So from FY19 to FY21, 3 years in a row, the auto sector was going through downturn. So what struck us is that despite the downturn in the auto sector, some of the auto ancillary companies were actually able to report growth in sales and profits. So this was the first hint that we got. So despite a sector going down, or despite a sector not doing well, some of the stocks in the sector are actually doing well, whether it is on the top line or bottom line. Maybe there may be different reasons, whether it is due to exports or product penetration or even rise in commodity prices and all. But this was actually happening. So that made us actually look at the sector in depth, and we could actually find many more companies that are doing the similar stuff, or where their earnings are about to match the peak levels of FY19 in FY21. So 3 years later, when the sector was not growing, some of these companies are doing well. So that actually struck us to look deep into the sector. And later on, we figured out that yes, the auto sector is also, the sales are also going to revive. For the simple reason that we are a growing economy and the penetration is also not that high. So a sector like this cannot hold down for long. So for whatever reasons that it has fallen, so it cannot hold down for long. So we were actually looking at numbers, monthly numbers, and all these things, and there were signals that it is going to revive. So by the end of FY22, it was clear that the first sector to revive was actually the commercial vehicle sector. And then passenger vehicle sector was also showing clear signs of growth actually. and the only sector that was ailing was two-wheeler sector. So that was also clearly visible. So the reason why two-wheeler sector was ailing was clearly visible from the NPA numbers, NPA ratios reported by IndusInd, no, not IndusInd, Bajaj Finance, or even other two-wheeler lenders, or all these players. So it was very clear that the lower end of consumption, or even the smaller commercial vehicles or the second-hand commercial vehicles, all these baskets, why certain segments are lagging, it was actually more visible from the lenders actually. So, and there we were actually seeing a turnaround where lenders are guiding that the bad times are over, or if we look at small finance banks, they are mostly into the CV financing. So they were guiding that bad times are over, they were able to recover money, the freight rates are going up. So that is where we also got a lot of other hint also. So that made us to believe that the sector is also turning around, because this is the sector that is dependent on loan, and the self-employers, they are all entirely dependent on loan to procure vehicles and all. So this was another hint. So these were the hints that actually, so the hint to whether a sector can come up or not at what point of time, that can come from different sources. So the first was the turnover, the growth reported by the ancillary companies when the sector was not doing well, and the second was that from lenders also, that reassured that the sector recovery is going to stay. So by that time, so we had figured out some companies from the ancillary space. We had some, we have some OEMs and all. So we thought of launching a small case. Then came the thought of disruption. So yes, now the EV is coming, disruption is happening. So that is something to take cognizance of, because we cannot say that this is not going to happen, because for the simple reason that you can see green number plates are increasing every day on the roads. So we decided to put a bit of additional effort there. So this is specific for this sector. So in some other sector, we may not need to do that also. So we put additional effort to ensure which sectors are going to take hit due to EV and which are not. And I'm not going to say that these are going to happen all of a sudden. This will take a long time to play out, because the EV adoption is happening at a slower pace. It is happening in two-wheelers at a faster pace. So it makes sense to ignore the ones that applies to ICE two-wheelers. But otherwise, in other segments, it is not catching up fast. So it may take a bit of time for these to happen. And by that time, companies should also diversify and all. But what is important for us is that we want to get into companies that are growing. So that is why we did all this exercise, and it also thrown up interesting other insights. So take the case of somebody making glass. It is not going to be disrupted, that is clear. So take the case of companies that are doing some smaller components like lights or instruments and all. There, what we found it extremely interesting is that the shift, the transition to EV, what it is doing is that whether it is halogen to LED lights, or whether it is from analog instrument clusters to touchscreen based instrument clusters and all, they are giving these companies 3, 4, 5 times realization than their traditional product. So this is what caught our attention, because if companies are going to make 3, 4, 5 times realization, whatever be the growth rate of industry, 5%, 6%, 10%, there can be companies that can grow at higher rate. And so that was other thing we were looking at beyond the normal growth rate, or beyond the companies that are going to get disrupted. So that came up because of this exercise. So my colleague Anu, she has put significant effort in figuring out companies and segregating them into different categories and all. So that is how we figured out. And so fortunately, we got high growth companies also from this space. And that eventually led us to actually putting up together a portfolio, this Auto Plus Plus portfolio. So we launched this portfolio in the first quarter of FY23. And FY23 is the first full year of recovery for automobile sector, barring the two-wheelers. Two-wheelers, it is a bit of a different story, but otherwise it is a full year of recovery for the sector. And this is how it has played out for this. Back to you, Vidya.
Yeah. So the plus plus signifies the revival and the transformation. The important thing that you will note here is that there aren't always very clear indicators about a recovery or a revival. Sometimes you take proxy indicators, like Mani wisely mentioned about the credit, the financing of commercial vehicle, so the credit growth. These are some of the proxy hints that one gets about revival in the sector. It may not directly, because when a sector is beaten down, you don't expect the earnings to kind of show up big time. The market would have picked it up anyway, right? So, so this is what we try to kind of, look at other information, that would support our thesis. And when they showed strength, we went ahead and launched quite early and reached dividends. There's also another portfolio. Maybe Mani, you can quickly take us through that to explain how we entered that sector, and then we can go on to Q&A.
Yeah, so we also have another portfolio that is Finance Squared. So it is a broader financial sector play and including financialization of savings. So, but the financialization of savings, now the problem is that we have regulatory challenges as well as taxation issues that are hurting two sectors. So it is not that easy to play on a broad-based level at this point of time, but still it is there are candidates to play to whatever extent possible. So it is actually the portfolio is more skewed towards lenders, whether it is urban or rural or specialized lenders. So again, as far as this sector is concerned, the banking sector actually bottomed out in FY 2019 because if you look at the provision numbers, so that was the highest provision. Every bank made the highest provision in FY 19. So that was the year when it bottomed out. We can say in the hindsight as that is easy, but again, COVID disrupted it again. But then again, the sector stabilized in FY 22, and we launched this portfolio just before the close of FY 22. So again, between FY 19 and FY 22, despite COVID, the only threat was the restructuring. So as RBI allowed restructuring, all these things, but actually the provisions were not spiking like that. The profitability was coming there. And beyond everything, what is more important, what is the realization, what is more important to understand, as well as the realization is that eventually it is a cyclical sector. And yes, this is how the cycles go up and down and end. So that is also one other point that we were discussing because it is the banking sector as such is closely aligned to economic cycles, and so we have seen it playing out for a long time. The good cycle played out for a long time. Then we saw all the crises coming, and we also saw all the realization coming. So what is more important is that if we take the larger banks that recovered like ICICI and Axis, they were actually struck with infrastructure and power cycle, and for them, they could actually realize back a lot of the NPAs through NCLT. So that was coming back. So they provided entirely in the books. So the loss was as a result of all these things, but they were about to realize the money. So actually that is the point of time where the rally and all that actually took off. And then we again saw this COVID disruption and all those things. So again, the earnings was coming. So we launched before the end of FY 22, and now FY 23 has panned out to be the best year on earnings for the sector. So to put in perspective, SBI reported loss in FY 18. This year it is about to report 50,000 crores in profit. So that is how it has turned around. But again, as far as the sector is concerned, so if you look at the performance, what is the determinant of valuation? That is ROA. And we have seen all the banks reporting almost best in class ROA at this point of time, which was driven by higher net interest margin, asset quality. So this is very important. So that is also recovered well. And then to an extent, lower cost of deposits until now. So now it is a bit changing. So, but what is comforting, despite what is comforting is that the credit cycle, the cycle is actually just 2 or 3 years old. And again, it is only the credit growth that matters. So if that comes, yes, the road ahead is clear. The profitable growth ahead is clear for them. Back to you.
Right. Mani spoke about two of our, small cases, and the important, takeaway is that we were timing perhaps, just about right with the auto sector, and but the finance, like he mentioned earlier, finance is always a heavyweight lifter, but also a key factor that pulls down the index. And both of these have been happening between the 18,000 in the past and 18,000 now. And to that extent, our F-squared portfolio still has a lot of stocks that provide enough room to kind of enter, and we are constantly looking at rebalancing stocks, especially in our auto, for instance. When stocks rally too high or give us less comfort for upside, we do look at rebalancing these often. So that's the thing. Mani, you can just move ahead with the slides. So that's about
I will just speak about performance also. So this also connects with the whatever we spoke earlier about the right sector, right valuations, and right stocks. So the first one, the Auto Plus Plus, actually we got everything right there, and you can see from the graph. So it was a takeoff initially, and then it consolidated, and then it is again moving up. So there we got it right. But in finance, you can see a sudden blip at one point of time. So after we launched, again, there was a fall in the index as well during July due to this Russia-Ukraine crisis and all those things. But beyond that, we also had to manage with one or two of the stocks that didn't go as we expected. So we had to take corrective actions. And from there, it took off reasonably well for us. So this is just to talk about the broader performance of all these two. And as I mentioned earlier, for both these two portfolios, the cycle. So for auto cycle, the FY23 is the first full year of good earnings for the sector. So it is just, we were just early into the cycle. And as far as the financial is concerned, at this point of time, yes, the broader re-rating in the larger players have played out, but that is not, that may not be true about the smaller ones. The re-rating may still be happening actually. And the credit cycle, so the credit cycle plus the credit growth, that are the two major levers for growth going forward. So the re-rating may be largely done, but for us who have the liberty to choose smaller stocks in the portfolio and all, there may be still candidates, or there we may have candidates in the portfolio itself that are undergoing re-rating. And the levers for growth are the cycle itself as well as the credit growth actually.
Right.
Yeah, that's it.
So yeah, so that's the part on performance. Just to kind of in all this, we would also like to explain that when we tried to approach investing in stocks, picking stocks, building portfolios out of them, we don't side with any particular style. We don't think we are masters of value or masters of quality or growth. We look for opportunities in the market and try to enter those opportunities, as plain and simple as that. Momentum works sometimes, momentum fails many times. Quality works sometimes, quality fails sometimes. Value underwent a prolonged period of underperformance, and it significantly gained ground now. So styles of investing are all fine. I mean, with when a mutual fund manager has to say, what style he's tied to, might want to say, but end of the day, as investors, as all of us are retail investors, for us looking at opportunities, pockets of opportunities in sectors, and within those sectors, trying to time them at valuations that give us comfort for upside, or give us comfort if things go wrong, right? And that is our approach to stocks. That is our philosophy to stocks as fundamental investors. So that's a kind of takeaway that I wanted to leave you with. Since couple of people again, so the raised about talking about history, please remember history is often forgotten. The learnings of history is often forgotten. And what COVID taught us between these, 2 years is that the market can, get many things. Generally, we say, the collective wisdom of the market is large. It is right. But oftentimes it can be deceptive, and to kind of sift through those deceptive periods is the only way to building wealth. And that's what we try to do at Prime Investor. So on that note, I think we will move on to, and Mani, can you just move to the last slide on disclaimers, just as a matter of, a routine. The disclaimer part. So I just wanted to kind of let you all know that, all that we discussed today, the stocks that we discussed, the last slide before the last slide. Okay, we don't have it here, fine. So just want to let you know that none of this is to be construed as, advice, and you need to make your own investment decisions. So on that note, I think Drashti, can I directly go on to a Q&A that is here?
Yes, sure, Vidya ma'am, you could go ahead, or if you want, I could also read the questions
No
for
problem.
you.
I can just pick and choose the questions.
Yeah, sure.
Yeah, Mani, since we have a finance squared portfolio, we have a question from Amit here, who wants to know our view on the bank Nifty, and is it making a new all-time high? I mean, we won't get into technicals, but possibly a very short, view on what we think, the bank sector is headed.
Yeah, sure. So that is the sector that is holding on the Nifty at 18,000 at this point of time. That is the sector where the earnings traction is still continuing. there are challenges, but the key challenge for banking sector is the deposit growth now. So that is actually hurting to an extent the earnings of banks. So what can compensate? So what can compensate for this challenge is the credit growth. There is nothing else other than credit growth that can compensate for this. So the only thing that even market is waiting for is the indication on that, because there are now concerns on slowing growth, slowing credit growth, all these things. But the moment there is indication that the credit growth is going to be robust, then this sector will still be on the driver's seat to take banking index forward. And to add to that, if this pause, whatever we are seeing in terms of the pause to interest rates from RBI as well as US Fed, actually this deposit rate increase, deposit growth concern, or the higher interest rates on deposit, that should also abate. But let us see, for one more quarter, the market would be looking to take for some cue on that. But barring that, if credit growth indications are strong, this is the sector that will be in the driver's seat. Yeah, that's it on that.
Right. So the next question, from Mr. Venugopal, who wanted to know which sector, in your opinion, will do well. We know what happened in the past. Sir, I can actually kind of put this out on chat. We have our Equity Outlook 2023. You can register for free to read, where we do give where we expect the year, and we have also picked stocks accordingly. To summarize it, we are expecting the Nifty P to stabilize, the market to kind of not move significantly in either direction, and we are seeing that pan out. The second thing, we did expect the capex story to rev up further, and that has been panning out. And the third thing is financialization of savings to support liquidity and growth. Our small cases are also in tune with our equity outlook for 2023. So you can check them out as well there.
So to add to that, so our recent recommendations would be pointers to which sectors we are banking on. So because we come up with very few recommendations, so that will be pointers to which sectors we are looking forward to.
Absolutely. The other question is on should we shift to debt funds, very short term, long term? I don't know what you mean by shifting, sir. If you mean you want to exit out of equity, in general, profit booking is a healthy thing. We call that rebalancing. So if you have a 60-40 portfolio and it has gone to 70-30, it is good in general to do an annual rebalancing. But other than that, if you're asking about shifting entirely to debt, I don't see a need. I mean, any asset allocated portfolio has to be allocated across assets at all point in time, is our philosophy. On the debt side, we have been, at Prime Minister, we have been giving very active calls. We did give duration calls a little earlier. And then as the shorter term yields really, became steeper, we gave shorter term recommendations as well. So I would suggest you go with a time frame based investing. If you do not need the money for the long term, keep a mix of short and long duration funds at this point. But if you're looking at less than 2 years, please stick to shorter duration where the yields are good enough for you to enter now. And you need not stick to debt funds alone now that there is tax parity. There are many small finance banks, etc., also giving good returns. You could diversify across those also. So that's the point here. Mani, this question perhaps is why there's a buzz this year in the second half, recession is due. In such an environment, having equity exposure is risky. Do we need to liquidate equity exposure?
Yeah, so this recession news has been going around for long. So definitely if interest rates have gone up from 0 to 5%, yes, definitely everybody would expect a recession, but that has not happened technically. And if we look at the US indices also, so at some point of time, I was looking at the stocks that were moving there. And what I was surprised is that the industrial stocks were all doing well in US market. So this is not something that we would expect when a recession is there. Whether it is the largest standalone truck making company, or whether it is the companies like whether it's Parker, Cummins, John Deere, Caterpillar, all these kind of companies are doing extremely well there. So it is a tricky question, and now again, even the US Fed has taken a call that they would take future hikes based on data and all. So if that is the case, then if data starts coming worse, then they would also reverse their stance on interest rate and all. So whether it will slip into a recession will be highly speculative at this point of time. Rather, the likely chance is that they would avoid a recession. That means 2 quarters of negative GDP growth data. So that may not happen.
Right. So the next one is basically on what's happening with the commodity sector. Is it okay to have exposure now? We did write a bit early about the commodity and the rise of the old economy at Prime Minister in about around February. I'll probably share the link here for you folks to read. And locally, given that the capex story has been strong here, leaving gold aside, which is a separate story by itself, steel companies and a few other metal companies have all done well. We have recommendations, but given that it's very tricky, it can be very tricky to enter at a stock level. We did give a recommendation at a fund level in February. So the next question, history, we know. What are your views on defense sector? Mani, you have a few words to say on that.
Yes, so I will take it up because this perfectly aligns with what we were discussing today. The valuation, the sudden rise in valuation and all these things. This is one of the sectors that is in limelight today. So the most important thing to understand here is where these stocks come from. So we had a bunch of defense IPOs in 2018 and the stocks literally halved like 50% or 60% from there. I mean HAL and this Bharat Dynamics and all. And even BEL, Bharat Electronics also fell from its peak like 50, 60, 70, 60% or so. So first, whether history is important or not, it is very extremely important to understand what caused the fall. Okay. So because this can repeat, that is the reason. So what caused the fall was a slower pace of order accretion, one. The second was the outstanding payments. So there was a news at that point of time. At that point of time, HAL was trading at 600 rupees or 650 rupees at that point of time. The news was that HAL is going to borrow 1,000 crores from banks to pay salary to employees. So why this should happen? This only happened because of payment delays. So this is not a point of time where anyone would like to get into that sector. And another important thing is that this actually whether it is the trading volume, whatever the activity happening in market. So a company that with 22,000 crores of sales and more than 2,000 crores of profit, the daily trading volume was just 5,000 or 6,000 shares. And this is something that was clearly indicative of it was completely ignored. And later on, what happened a year later is something totally different. Government cleared all the dues, and in the next financial year, exactly in the next financial year, HAL reported surplus cash because all its dues were cleared, and that is why the sentiment lifted up. And when one defense PSU resource, it is obviously all other defense PSUs are receiving that money, so that concern got abated, stocks got re-rating. The second thing that was happening was accelerated order accretion, and then the Russia-Ukraine crisis. Obviously, what that would mean is that the supplies around the globe for defense procurement will be limited. So any country who wants to procure defense equipments, it would not get immediately, it would come with a lag. To put in perspective, in history, this has happened for one other stock. There was BHEL in 2008, where their lead time to deliver a new order on boiler was 2.5 years. And that is how government opened up the supplies to actually Chinese suppliers or Korean suppliers actually. So again, for companies like HAL and all, or whether other defense companies and all, market was building a thesis that defense supplies are going to be extremely tight. And then so governments will have to bank on players like domestic players to procure more defense supplies. And in between, we are all getting all these kinds of trust and all these kinds of news and all these things on government giving new orders, procurements, all these things. Now, let me come to one other important point. as far as HAL is concerned, or Bharat Dynamics is concerned, or HAL players are concerned, or BL are concerned, we are listening to orders now. Whatever orders are coming. So last 3 months, if you listen to, we might have seen a lot of numbers coming and all. So if you go back and listen to a con call in May 2022, so I am referring to a con call that happened exactly 1 year ago. The managing director was clearly giving an indication of whatever orders that are going to come for this company. Okay, so this is the only company that is making those. So the order has to eventually come. Okay, from that point, at that point of time, the stock was at 1,200 or so, and the managing director was clearly telling what all orders that are going to come for the company. That con call is still available in public domain, May 2022. And from there, the stock has literally rallied more than 100%, not even 100%, more than that. And now the numbers that are coming in orders, now the orders that are coming in are the same that he spoke about in 2022. So we should actually think about whether market has already figured it out or not. Okay, so it would be unsafe to assume that market has not figured out, and it is now only market is realizing that the orders are coming and all. So in my opinion, there is too much of discounting that has happened in the sector. And if the payment related issues or the order accretion slows down or all these things don't happen, it will again become a warning sign for the stocks to correct sharply. So it is far beyond the safe zone, in my opinion. And again, as a disclaimer, I may have personal holding in some of the defense stocks discussed about.
Very clear views from Mani on the defense sector rather late in the day, and the question of whether it can sustain. Two last questions probably, we'll just take off before we close the session, maybe Drashti. The stream of layoffs happening every week in companies, what are these indicating? I think we should be aware that the layoffs that we are talking of are in places where they were added in excess, right? Whether it was e-commerce and fintech, IT made significantly high hiring at very high cost, and they thought this cost economics would work forever. And once office people started going to offices, the costs again shot up and then didn't work. And suddenly in e-commerce, fintech, etc., companies have also realized that it is not just about the top line or getting the leads and addition, but it is about profitability as well. And that, I think, has started sinking in. And to this extent, I would only call this removal of excesses and would not attribute it, at least in India, to any kind of significant slowdown that's happening. The last question, what's the view on floating rate bond funds? Yes, floating rate bond funds help, capture, rates, especially when we are not very clear whether the rates are going to fall or when they are going to readjust. Floating rate bonds always make for great, investment ideas in one's portfolio for the, kind of medium term. I would say not for the short term, because some floating rate bonds, can be quite volatile because they do hold longer maturity papers also. It's not just interest rate swaps, they do hold other papers. So they can be volatile in the short term. So if you have a medium term view, is definitely a portfolio can have a floating rate bond. So I guess we are at the end of the questions that we have here. I thank Dan for this opportunity, and I hope that you folks will check out the small cases we have in which there is still a significant opportunity to enter. You can go up and read about our thesis on these, and you can also check out, how to go about investing in stocks in general can be learned in primeinvestor.in/varsity. It is a free for all place to, learn about stocks, mutual funds, insurance, and a whole lot of personal finance products. I hope you will benefit from those as well. Thank you again, Dan. Back to you, Drashti.
Thank you so much, Vidya ma'am. Thank you so much, sir. I'm so sorry I took the wrong name of you at the first time. But yeah, ma'am and sir, this was a very insightful session for everyone, and I hope everyone has learned a lot and all their queries were also answered. If there are any other queries that someone has, you could write us on our community, which is community.dhan.co, where all your queries would be answered. And yeah, surely you could see the Prime Investors portfolio on our app as well as on our web. So this was all for today. Thank you so much everyone for your time. Thank you so much Vidya ma'am. Thank you so much.